right. Thank you, Jillian. Welcome, everybody, to what looks to be a very interesting afternoon of information about alternatives and hedge funds. I'm going old school with my paper as opposed to the iPhone or iPad. So this panel is about emerging managers, what it's like to stand up a new fund in the current environment. Before we get into the nitty-gritties, you know everybody's name. Why don't we start at the end and each of you just tell us about your fund and what makes it unique. Let's start with at the end.
Sure. Matt Jozoff. I'm running Trevally Capital, and our fund is an agency mortgage focused fund, and the firm is a mortgage focused overall firm. And I do want to make one legal announcement really quickly, so bear with me. My remarks today should not be taken as an offer to sell or a solicitation of an offer to purchase any securities or interests in any funds, and should not be construed as an undertaking to raise money for or to advertise for any fund, and any statements made today should not be construed as investment advice. So there you go.
I think I said
ditto for him.
Ditto, straight across the board.
So now I've made my compliance officer happy. But yeah, our fund is a mortgage, or our firm is a mortgage-centric firm. We really specialize on getting loan-level data. We have a big investment in quant effort and research, and we use that to find alpha and generate returns.
Imran, how about you?
So Imran Khan, I'm the founder and CIO of Proem Asset Management, started it 6.5 years ago. We're a global long-short technology fund investing globally in technology, only in public market. I think our big differentiation is I probably have a very unique background. I started as an analyst and then went to banking at Credit Suisse. And then I was an operator at Snapchat, ran over $1 billion revenue business at Snapchat from zero, and then launched the fund. So we bring our different angle that over the years we learned on what makes a great stock, and we put that with analytical framework and trying to generate alpha for investors.
Matt, how about you?
Yeah, good afternoon. I'm Matt Cherwin. At Marek Capital, we're thematic and relative value investors. We trade rates, mortgages, securitized products, corporate credit, some related equities. It's the products that I've traded for 20 odd years, starting from day one when I was a CMO cash flow structure and traded ABS all the way through subprime, and later on was running mortgages and credit for JP Morgan. And really though, informed by my last few years there, where I had a very exciting and unique opportunity to be the treasurer and CIO of JP Morgan, which was one of those moments where it was really one of those things where like 6 months in, I started to think like, wow, I'm actually learning how a bank really works, how the financial system really works, and had one of those moments I think like a lot of us have had where you say like, oh, okay, I've been doing this for 20 odd years, I know nothing. And now I'm starting to learn. So if you're like us and you've got classes, it was like when you go to the optometrist and they give you a new prescription and you put them on and you're like, now I can see. And by the way, how was I walking around the streets of Manhattan prior to this? So it informs everything we do. It's how we look at the system as a whole and how we think it impacts all the products.
How was I trading securitized junk before I understood what the system was actually like?
Look, it's been, I've worked for incredible people with great teams. We've been through pretty wild and hectic markets. We were, kind of makes me think, we never called it junk, by the way. I think what we, look, sometimes people say the market was frozen. I've heard that a lot. Like, I've never seen 25 years in these markets. I've never seen a frozen market. I've seen markets where people don't like the price.
Spreads blow out.
Well, you could say like, we traded $1 billion today. You say it's frozen. You just don't like the price. Like there's a big difference between that. We always focus on products that we thought had a clean intersection between what's good for capital markets, what's good for the consumer, what's good for the investor. I'm a big believer that efficient movement of capital and liquidity through financial systems unlocks value, whether you're looking at a security, an economy, a marketplace, a structure. So I think they all work together.
There's a great quote, I don't remember who I'm stealing this from. Trade takes place when there's an agreement on price, but a disagreement on value.
Well, I always say that like when the trader thinks they paid too much and the client thinks they sold it too low, you probably established a fair price.
It's a perfect price.
Yeah.
So we've held this panel, I think this is the third year in a row once we opened up post-pandemic. Kind of fascinating, last year, were all people who had come from large multi-strat funds. This year, you guys are JP Morgan Chase in your background, Credit Suisse.
I was at JP Morgan as well.
You also.
I just realized that all three of us
all three
at some
come
point
out of-
had worked at JP Morgan.
And two Matts from JP Morgan to make it even more confusing. But I'm really fascinated. The startup process has to feel so different coming from a big bank or broker where whatever infrastructure you need, you call IT or you call legal or you call somebody and it's done. Why don't we start with Matt at the end? Tell us what was surprising about standing up a firm and launching kind of from scratch.
So yeah, at JP Morgan, I was there for 15 years running fixed income research. And with several hundred people reporting to me globally, we had access to anything we needed at our fingertips. And there were tons of systems. The budget for technology at JP Morgan is tens of billions. So this is like the scale of it is massive. So that was the benefit of being at a large firm like that. But I think it also has the downside where if you want to do a model, build something new, you have to get everything approved and documented and written up. And I remember just one little model was a 500-page document that we had to produce for the Fed to inspect and for the internal compliance and such. So if you think this compliance statement was bad, imagine, at JP Morgan, no offense to our compliance people. So coming to a new place, I think was definitely different, but it's something I really wanted. I wanted to get away from that bureaucracy and build something new. And it allowed us to actually build technology systems to look at data across over 11 million loans in just the Ginnie Mae world, let's say. And we can slice and dice and cut and map these loans to a bunch of securities in ways that we couldn't do at JP. So the nice thing about starting up is it's extremely challenging because you have to build everything from scratch. You have to hire the people. You have to build out databases. There's a lot of work. But on the flip side, you create something without the legacy baggage and problems. And I think that's part of the exciting part of it. I will say the other thing that was amazing in a not great way is just the amount of infrastructure you have to build. Not just technology, but legal, compliance, PPMs, data rooms, like all of that stuff to build an industrial strength team and firm is really a big investment up front.
Kind of shocking the amount of work it takes separate from getting clients and managing the investing.
Yeah, you take it for granted at a place like JP Morgan because it's already been built and you're just living and benefiting from all of that. But having to build it from scratch, you realize, okay, it's a pretty large investment in time and money.
So Imran, you've been up and running for a few years, but before I give the same question to you, I have to just annotate your introduction because you kind of downplayed. You were at Credit Suisse. You were head of technology investing. You brought how much in IPOs, tech IPOs, out to the public?
I predominantly focused on internet, but my biggest client was Alibaba. So
Right.
I did all of their transactions between 2012 to 2014. So I'll help them buy back. Yahoo owned 40% of Alibaba. We bought back 20%, half of that for $8.8 billion. Then we financed that. And probably the most interesting thing was we convinced Credit Suisse to put $50 million investment at $18.50 that we sold at $95 at the IPO,
Nice.
and then took them public. So that was a great 36 months run. It was a client that constantly paid us.
So that's nice to have.
Yes.
Then you decide to launch your own launch.
No, I went to
fund.
Snapchat, sending
that?
disappearing message. Snapchat.
That's right.
How many of you
You
Snapchat?
did that.
Anybody? Nobody? Or few people?
You helped
Older
take them
crowd.
public, right?
Yes.
So what was it like standing up a long-short firm after having all the resources of Credit Suisse behind you?
Yeah, when I went to Snapchat, we didn't have that many resources. So the company has sub 100 employees, and we had zero revenue. But because in Silicon Valley, users are growing, I think the first thing I did raised $1.8 billion. So we had a lot of cash. So that made life much easier. I think when I started the fund, I think my biggest takeaway was any financial institutions, my biggest takeaway in 2008 was that how fragile every financial institution is. And so my first focus was that let's just make sure that we have right compliance and right infrastructure because we can have all the best ideas in the world. If you have a fragile infrastructure, you're going to die very quickly. So 2008 was a big learning experience, like what I saw at a very young age. And so we spent a lot of time, finding the right legal team, like Paul Weiss, building the right PB. I was lucky because I worked at JP Morgan. My fund was small, but JP Morgan and Morgan Stanley took us in. So those are the things that really was my big focus, and getting those lined up, and then can focus on getting your ideas right and things like that.
Matt, you have the same experience standing up the firm and dealing with everything outside of clients and investing?
Yeah, I guess I would say, look, I've been on the sell side and I've been on the buy side, and now my partner Derek Goodman and I are launching a new fund. When I was on the sell side, my whole team complained that the buy side was so much better and so much easier and had all the information. When I was on the buy side, they said, oh my God, it's so much easier on the sell side. There's a lot of bells and whistles that come with both. There's a lot of regulatory framework around that. I think in this environment, it feels very familiar to me when you're clear-eyed and focused on what you're trying to build, sticking to what you know very well, where you think you have something interesting to say in a defined set of experience and a precise area you're applying it to. A lot of the other stuff falls into place. And I think just like these guys said, I mean, if you're not, a friend of mine started a company a little bit before us. I said to him, how was your weekend? And he said, what's a weekend? And I was like, I didn't get it. And then we started doing this, and I was like, now I understood what he meant. So the days, and it all blurs together, but when it's yours and you're defining the vision and you love what you're trying to do and the markets you apply it to, I think it's a really exciting process.
So I like that phrase, defining your vision. Let's delve into that and talk about what each of your visions are, how you differentiate your firm. Let's start with Matt at the end. Define your vision.
Yeah, I think our firm is really founded on deep mortgage experience. So if you look across the team, we talked about my background. I ran research at JP. I was at Goldman before that, running mortgage strategies. I was ranked #1 institutional investor. So I came from the research sleeve. My co-head he used to run a public REIT. So he came from the public company side. We've got deep trading experience. Our quant expert came from Tudor for 20 years. So you get half a dozen people like this together. I think that's one of the main drivers that we have. I think that it's a depth of real mortgage experience, but each person has a different angle on it, whether it's research, trading, finance, quant, et cetera. So I think that's probably our main focus and main strength. If you look at, in addition, we have backing from the Raptor Group, which is Jimmy Pilata's family office, and that gives us a lot of, he's just given us tremendous financial backing, as well as references and connections to investors and others, which I think is helpful, and it really builds a stability within the firm, which is important. When you're talking to prospective investors, they want to make sure that you're in this for the long haul. And then I think the third thing, and I touched on this earlier, really, we're not trying to take views on interest rates or views on the Fed. We were talking about this earlier. I don't know any better, what Powell is going to do. That's not our strength. Our strength is really looking at the intricate mortgage data and finding alpha in things that the market isn't looking at right now, and then expressing that alpha. So that is basically, that's our vision, is basically creating a firm. And after this fund, we would like to branch out into other things like a REIT, or like warehouse lending, or like a mortgage originator, things like that. There are a lot of things to do in the mortgage space.
So quick follow-up. Given post-pandemic, how little inventory there is, the uptick in cash purchases, how does the sort of decrease in mortgage volume in 2025 versus pre-2020, how does that affect your business?
I think our business, there's a lot to do in a lot of different mortgage environments. Right now, we're seeing delinquencies increasing steadily in some of these lower FICO borrowers. That's a big, big trend, and there are things that you can do to take advantage of that. We take advantage of that in the prepayment space, not in the rate space. Secondly, there's a ton of home equity that's built up. Sure. 15 trillion of equity is out there that has a mortgage on it. So there are things that you can do there. And even if interest rates fall from here, there are refinancing opportunities then that come in as well. So I think you could express home prices, delinquencies, mortgage credit in a variety of ways. We express it through mortgage prepayments, but we're pretty excited about the opportunities in that space. And whether it's a low rate environment or a high rate environment, we're not focused on what the direction of rates is. We're focused on the opportunities in that environment, if that makes sense.
Now Imran, I think you're the only long-short investor here, is that right?
I think so.
Right? So tell us what it's been like in this environment that has been pretty volatile since you launched your firm. You had Q1 of 2020 down, I don't know, 34% on the equity side. 2022, first time in 40 years, stocks and bonds both down double digits. And then, April this year was a little bit of a hiccup. How are you managing your style in the current environment?
Yeah, I always think volatility is your friend. And I think, I always like to tell the story that in 2007, I took a company public in Brazil, Mercado Libre. They were doing $100 million revenue. Fast forward 18 years later, they're doing $15 billion revenue.
Wow.
And every time somebody called me up and said, hey, Argentina going bankrupt and we should not cover this stock, I should have, I couldn't buy. If I was smart, I could have quit JP Morgan that day and invested. But the reality is, I think technology is such an interesting category. Think about, in my lifetime, this is the third cycle we're going through. First cycle was when I graduated, people were building website. Second cycle came along this mobile app with the launch of iPhone. And then the third is we're going through pretty significant evolution of artificial intelligence that's, I think people now only talking about infrastructure, but the application that will be built on top of AI will fundamentally change how we operate in our life, from digital workforce to defense and to other things. So in many ways, I try not to get too bogged down on day-to-day, the world going to hellbasket, just really focus on where we think create long-term value and how we manage the risk along the road based on the volatility. And we use a lot of derivatives to manage our risk. But that's how I focus on trying to find where the biggest dislocation is happening. And when the dislocation happens, the good news is there are winners and there's losers. One of the most interesting things is that when you have a platform shift, not always the incumbent wins. Half of the times half of the incumbents win, half of don't win. So I think in many ways, long short makes it very interesting.
And Matt Cherwin, let's talk about how you differentiate your firm. What makes you guys unique in the space?
Yeah, there's a couple of things. I would even just quickly follow that. We trade from the long side, short side, pair them off. These markets that we're trading afford us those opportunities. They've evolved a lot in the last few years. The way we look at the world, if you take something like commercial real estate, it's just a space that I love. You have CMBS bonds, you have CRE REITs, you have OpCo, PropCo, you have corporate bonds that own buildings. So to me, these are tools in the toolbox, the package that it comes in. You could be long, you could be short. What we look for asymmetric options. I've been trading convexity my whole life. A lot of times it's negative convexity. Matt knows this very well. When you grow up, we've all felt negative convexity. Sometimes we try to put numbers on this. But we look for, we kind of keep it simple. We look for places where we think we got multiple ways to win and one way to lose. I would say, and I guess I will answer your question at some point, but I'm not a salesperson, so I kind of say what comes to mind.
This is more interesting than anything a salesperson is going to say.
Well, I appreciate that. You can tell me later if that's the case. But, we look at the world through a certain lens. Some of the things that we have understood over time, I traded subprime mortgage bonds in that crisis. We had the taper tantrum. We had the euro crisis. I was the treasurer of a bank during the repo crisis. We had the pandemic. These crises, we're pretty liberal with that term. They come pretty quickly. What I learned, and Imran mentioned, how fragile the financial system is. I learned in that seat that I was in, which was really helpful. People don't really understand how the financial system works. So two things, this comes back to your question, is where do we think we differentiate? I spent a couple of years where I went from being what I felt was captain of the ship to going to work in the engine room and seeing the plumbing, the gearing, someone up top pulls a lever, they think something happens. Is it going to happen? What's stopping it from happening? What will unleash it? Is that what you're trying to accomplish? Is there a better way? Now, I would say on a practical standpoint, what I learned, because when we're investing, I think a lot of us spend a lot of time on assets. You don't go out of business because of your assets. You go out of business because of your liabilities. And when you start to think of things that way, you start to think about where is it going, where does it come from, who needs it, who's got it. And my last few years, I think, was just a larger expression of that. So, this is a purification of what I've been doing my career. The great news is these are gigantic markets. They trade very often in very large size with investors who have completely different mandates, which means they price differently all the time for things that are the same, and they price the same all the time for things that are different. And these dislocations exist constantly. And that's what we try to think about. And then where do we find the overlap? Like if you look at where did we come into this year, you had a marketplace where, Trump won the election with a broad mandate. I really don't care whether you like him or you don't. It's not a politics thing. Like he won the election, he had a broad mandate, controls Congress, and an expansive agenda. We looked at this and said, that sounds super complicated. Okay, he wants to do a lot of degrees of freedom, a lot of ways this could go. And then we looked at the market and said, the market is basically saying, this is all going to go very well. It's going to land in a very narrow lane. And if it all goes very well and lands on the lane, you're going to get a very small payoff, right? So the trader in us thinks right away, like, how can you take the other side of that? And those are the things that we start to look at. We take these markets, we take the instruments, we take what they're selling them, and then we look for like, what is everybody missing? Like right now, okay, so what did Bloomberg put on its screens for a bunch of today? Powell getting grilled by the press. Now I think Powell, we kind of joke at the office that like Powell has a little desk calendar where every day he crosses off one more day with a red X and is like, when do I get to leave? Okay, so the general consensus is that QT will stop somewhere around year end. The general consensus is there will be a new Fed chair. This is in May 2026. The consensus is Kevin Warsh most likely will be that Fed chair. Okay, he may or may not. Okay, but you've got, okay, those are the high probability events. The first one I mentioned was QT stops around year end. Kevin Warsh does not think that, and you can listen to any one of his many YouTube speeches, his written speeches, he has very, very defined opinions and thinks the Fed should be much, much smaller. He thinks that the balance sheet should be $2 trillion smaller. When you shrink that balance sheet by $2 trillion, that means these securities come back out, deposits get smaller, someone has to own these bonds, someone has to take the duration, someone has to take the convexity. Where does it go? Okay, and this is just a topic we've spent a lot of time the last couple weeks working through. That's where our thought process begins. And it's kind of applying that mentality. We look at the world through the lens of money, capital, credit, liquidity, and regulation. Like that's top five. You're a music guy, right? People say, what's their top five artists? Mm-hmm. We say money, capital, credit, liquidity, regulation. That's our top five. And that tells you how monetary policy works, how housing structure will work, whether liquidity will be provided by markets, whether there will be balance sheet, whether you can take risk, whether risk will be provided. We put new names on things. We call it private credit now. It's been around for a long, long time. We call it something new. Securitization got a new name. We missed it, by the way. They gave securitization a new name somewhere along the way. That's great. This is just levers and wheels that turn capital through the economy, and that's what we think about all day long.
But to Matt, I was just going to say, to Matt's point, I think it's a really exciting time to be in the markets. I mean, you mentioned the Trump administration and everything they're doing. You're talking about in the area where we're focused, a $9 trillion mortgage market, and the potential to reform Fannie and Freddie. Think about the impact that could have. And you talk about asymmetric options. Everybody assumes this is all going to work out great, but there are scenarios where it won't. Where there's scenarios where there's a lot of volatility or opportunity. So I think, to your point, I think it's a really exciting time to be in the space.
So we're talking about opportunities. We're talking about crises. We seem to get a 100-year flood every year. Maybe we need a better name for that situation. So given all that, when each of you guys launched your firm, were you thinking, hey, great opportunity, or was it more, if I don't do this now, I'll never get around to doing it? What was the thought process like? Start with Matt.
I felt like there were great opportunities. From the desk at JP Morgan, I saw certain things that I'd love to pursue and do. It's very hard at a place like that. to do some of those things. And so I think some of it was that timing. I think some of it was also the fact that I connected with a number of colleagues and other people that formed this team with a deep mortgage experience with different sort of areas of focus. So whether it was, like I said, trading or structuring or finance or research, and the opportunity to focus on a few of these these trading positions and to really flesh those out and look at them through a different lens, I thought that was incredible. And then I think on top of it, the fact that we did get this backing, we actually have the backing from the Raptor Group that I mentioned and Seaport Global Securities. I think that really then that was really the point where we just said, yes, this is great. Like we are all in, and this is a great opportunity that we can really flesh out and run with. So it was a kind of all of those things coming together. Some of it was timing and the right people, and some of it was the backing, and some of it were the ideas. So that's kind of what brought us all together and got us started.
Imran, you've been up and running 5-6 years?
6.5 years, yeah.
Yeah, so before the pandemic, what motivated you to hang your own shingle instead of staying with either Credit Suisse or one of the tech firms you work with?
Yeah, I think between JP Morgan, Credit Suisse, and Snapchat, I worked for somebody for 19 years. So I felt like that, I got to go do something entrepreneur. Proem, actually an English word that has not been used for 600 years. It means preface or beginning of a book. So I said, after 18, 19 years, I owe myself to try something. The other thing was that, what I learned over the 19 years, that in technology, every 6-7 years, something new comes out, right? So late 90s was internet, then we came along, we had SaaS, early 2000, then we had mobile apps, and then we had crypto, now we're seeing AI. So every 7 years, there's something comes up, So I feel like it's a very interesting space, and if I want to do something for a long period of time, it'll keep me interested and learning new things.
Matt, how about you? What was the timing that said now's the time to set up your own shop?
I mean, I've been wanting to do this for a long time. I think when you're in a seat like mine, you spend a lot of time thinking like, should I start my own fund? What's the stock price? Because we're all getting paid and deferred and stuff like that. Where's the 10-year note? Where's the stock price? Should I start my own fund? Like 900,000 times a day. But I like the, I like the accountability. I like the authenticity, the ownership of it. Like we're sticking to our knitting, what we know. I don't think it's, these are long-term markets. We're not long, we're not short. These sectors have unresolved questions. It's the same exact questions that were unresolved when I wrote a market recap 10 years ago, same topics. None of them have been solved. They still keep coming around. The markets have gotten bigger, more active, more liquid, maybe not more efficient. It lets you trade in all sorts of different forms now. We think the opportunity to provide, I just look at it as, can you provide consistent returns year in? I grew up in a mark-to-market framework. Okay, can you provide consistent returns day in and day out? Might not always happen. Quarter, month, year. Can you do it again? Can you do it again? These markets provide that opportunity. We look at it as, can we deliver the type of return? I feel like I should borrow Matt's little disclaimer, but because I don't want to say anything I'm not supposed to. But we're stewards of capital. And we think that these markets provide the opportunity to generate pretty consistent returns through time that are exciting to people within a controlled risk framework. And can we do that in the products that we know and love? Yes. And is that exciting to do? Absolutely. Like I looked at it as, I've had 2 jobs in my career. I was at Citi for 10 years and I was at JP Morgan for 16. And so, it was one more job, whether it's 16 years or 26 years, I don't know. But the opportunity, we think it's now because last year was great. I think people said to me like, oh my God, how are we ever going to top 2021? And I said to them like, well, look at what's going to happen in 22 and 23 and 24. We just talked about all sorts of topics now. GSE reform, we've been talking about this for a decade. I feel like I saved myself a lot of time in the last decade not talking about GSE reform, right? We'll get to it. But
it's been 15 years, 20 years.
Yeah,
Time flies.
Yeah. So I have strong opinions on it, but I feel like there's a better use of my time right now in the market. the sectors and the evolution that's happening in markets these are decade-long processes.
Really, really interesting. So let's talk a little bit about building. I've probably heard from more CEOs, regardless of size, that the hardest thing they do is hire and compete for talent. Let's talk a little bit, starting at the end with Matt. How challenging is it to compete for talent when you're not at a behemoth like J.P. Morgan Chase?
This may surprise you, but I mean, we have about 10, 11 people now. I have people calling me, like on a pretty regular basis, reaching out to me from some of the banks or wherever, because I think it's an exciting place where people want to go, and I think they see the caliber of people, and they say, and it's a small shop, and they're like, wow, I could do something impactful and make a difference here. So I think to attract people in general, like we're not, you have to hire at the appropriate pace. So we've been fortunate that we found the right people, we think, at the right times as we needed to grow. I think, though, in general, to get people at this stage, because we are a startup, you need to give some people some upside, right? You have to give them a piece of some of the performance or something so that there is a financial incentive to come. But I think the environment is one that is, to be able to be at a smaller firm and make a difference, I think that's what people really want in their career. And kind of what Matt was saying, being in the engine room, when you're at J.P. Morgan Chase, everybody thinks like, oh wow, it's J.P. Morgan, it's so, so prestigious and all of this. And it is, until you walk through the revolving doors and go into the engine room, and then you start working away and pulling the levers, and then you realize, like people want to do something and make a real difference and really get excited about an idea and be passionate about it. And I think that's why I don't think it's so hard to attract people. It might be easier than you think.
Imran, what are your thoughts about the competition for talent?
Yeah, I think, the lesson I learned at Snap, we went from 100 people to 3,000 people during my time, is that you always try to hire people who are missionaries as opposed to mercenaries. So, there are a lot of places that people will always pay, and so if you're just hiring people based on comp, that's never going to work out. So, so what I'm trying to really looking for, what Matt basically said, is people who wants to work in a startup and wants to learn that. So that's one thing. Second, I have a little biases that operating experience, at least in my sector, gives you different perspective. So we try to hire people who have some operating experience as well as financial experience. And then the third, I focus more on the process, because if you can get the process right, then you reduce the talent risk significantly, because you can continue to follow the process that works. So those are the kind of way I think about it, rather than really competing for somebody working in a bigger firm and has a great track record and things like that.
Matt, what's your experience?
Yeah, I mean, I agree with these guys. There's great talent out there. We've had no trouble attracting people to our model. They're very excited about it. I mean, I've hired lots and lots of traders over the years. I know what I'm looking for. There's a lot of smart people out there, right? But we look for intellectual honesty, integrity, academic curiosity. You put that together, you build a high-performance team. Doesn't take that many people, by the way. It really doesn't. But what I do now is, one little dividing line is I say to them, let's just be clear what we're doing here. This is a startup. It's going to be really hard. A lot of work. Really hard. And I find a lot of people go, cool, that sounds exciting. I'm like, okay, all right, let's talk more.
Really, really interesting. What's been surprising to everybody, when I stood up my firm 13 years ago, I was shocked how much time you spent on non-client, non-investment, compliance, legal, marketing, trading, accounting, like just everything but the core of what attracted all of us to this business. What's been the big surprise for you?
Yeah, I think, there was a time when you could start a fund or a firm with two guys in a Bloomberg. No offense to, our sponsors here. Bloombergs are critical. We subscribe. But these days, investors, they want to see an industrial strength, solid offering. They don't want to see two guys and a Bloomberg. So, so from that perspective, what surprised me is the first 6 months at least were spent writing a PPM. That's our compliance person, thank you. The legal compliance, he did that. Writing a PPM, writing out the data room, the strategic relationship agreement, the compliance manual itself, the code of conduct, like all of these things. You think, well, we'll get to it eventually. No. Investors want to see that, and you have to go through a rigorous evaluation on operations and such. And that also involves, you can't start talking to investors if you don't have, you need a website. You need a really professional looking presentation. So there's a lot of stuff you need to build out first before you can do it. So that was, to me, I think the biggest surprise is just the amount of upfront work.
6 months? 6 months worth?
Well, the 6 months just to get to the point where you can actually maybe talk to investors. It's an ongoing thing, but you're constantly building out operations and stuff. But there's a minimum viable product. I'd say that was, for us, it was 6 months, let's say.
Imran, you've stood up a couple of startups now, or at least you've worked at a couple of startups, plus your own. What was the biggest surprise you experienced in standing up your fund?
Yeah, I think probably the biggest surprise is that how important it is to build strong partnership with your service providers, right? Whether it's banks, whether it's a legal team, obviously in addition to outsourced legal team or compliance, all these things. And that's probably one big area of that. Developing those collaborations is super, super important. And investing in your partnership relationships, right? With prime brokerage relationships and your research partners relationship, all this kind of relationships development. And then the second thing is, like any team, like when you start, make sure that you have the right team and they get along together and they have a right culture. Developing the culture is really, really important. And I always talk about that culture starts at the top. So, I can't demand a culture that I don't live up to. So I think those are the things, always hard and surprising. But that's been the experience.
Matt, anything different to add to that?
I would just say really quickly that, I've always said I think Wall Street's a kind of funny place. Like they take someone, they say, you're good with numbers, you're really bad with people, let's put you in trading, right? And then you get to a phase where they're like, oh, this is going great, you're so good at trading, why don't you stop trading and start managing people? It's like it's built to fail.
Right.
We set out, my partner Derek and I, when we started this, he's run funds, built funds, I run asset. We've both done the other, but we set out very clearly roles and responsibilities. He runs the company, I run the assets. There's a lot to do, and it's important to have traders trading, business builders, business building. Like you need to understand what the other people do. It actually even helps you understand Wall Street. Helps you understand whether bonds are going to settle or not. It's pretty helpful to understand, to know whether markets are going to function, what prices should be. But being in your seat, doing your job, the overwhelming amount of the time, that's half the battle.
So let me stay with you. What's the hardest question you get asked by either limited partners or allocators?
You're getting a dose of it right now. I talk too much, my wife would say, I don't talk that much, but when about these topics,
right?
I just find it fascinating. I think there's an overwhelming amount to do, and this is how we, search for clues in the markets with our team. Investors are like, we've got an hour and we've got 10 more things on the agenda. But you know what? Look, we are who we are. We talk about what matters to us, how we're building the business, what's important, and then we take it from there. So I think they're all pretty challenging meetings.
Imran, what's the toughest question you get asked?
I would say the toughest question, I think it's the personality. If you want to invest in technology, you kind of have to believe in future. Mm-hmm. And there are a lot of people who doesn't think future. They're more focused on narrow what's happening today, versus tomorrow. And I've seen that in my 25 years of experience, that people just cannot. You need some sort of imaginations in addition to your strong financial analytics to be understand what's happening in tech, and because you're thinking out 5 years, 3 years, 4 years out, and so I think it's finding the right personality. If you don't meet a person who doesn't care about 3, 4, 5 years out, that's not a productive conversation.
Glass half full. Matt, how about you? What's the most challenging question that gets posed by allocators or LPs?
I haven't seen any, actually. No, I'm just kidding. No, there are some tough ones. I'd actually give you a two-part answer. One is...
Do you get asked, like, tell us what other fund is like you?
Yes.
I feel like that's like a giant
we get that.
trap.
We get that all the time.
Who else should we give our money to?
Yeah,
instead of
exactly.
you?
I would say no one. No one is, no, I would say there are really two questions. One is, show us your track record. Now, we're a new firm, right? We just started. So you could say, well, we just started, and that kind of ends a conversation. Or you can do, what we ended up doing is actually going back, taking the strategy and running it backwards, and basically simulating returns. And that's a way of really making sure, fleshing out your ideas and trying to answer that question. So that's, I'd say the first question is that. The second one, which is frustrating, I think, is what bucket are you in? He knows. So like, what you guys in the audience who aren't familiar with this might say, what does that mean? So are you long short equity? Are you structured credit? Are you fixed income? Are you relative value? These
macro.
Are you macro? Yeah, I hate macro. So like, whatever. But like, so we would answer it, well, we could be in these three buckets really. But that's like the allocators and the investors, they want to know what bucket you're in because they're trained to think, they in a very kind of formulaic way, and their organizational structure also mimics that. So those are the tougher questions, I would say.
All right, last question before we go to the audience questions. What's the best piece of advice you received before launching your firm? Let's start with you, Matt.
Oh, gosh. I mean...
Or the worst piece of advice.
I just, I've had a lot of great mentors over the years. The thing that comes to mind, it's not necessarily in this framework, but like, it just reminds me, someone told me like perception takes a long time to change. It just kind of reminds us like this has been, it's a relationship you're forming with the investors. It's a long-term conversation. You're getting to know each other. They're getting to understand your thought process. It's just a process.
Imran, best piece of advice?
Yeah, I think the best piece of advice was that when people give you money, they give you their trust, and it takes a long time to build a trust, and it takes a second to destroy it. So be patient, build trust over a long period of time, and you'll get there.
Very, very interesting. Matt, best or worst piece of advice?
Well, I don't think I've had that much bad advice, but the best advice I think was figure out what bucket you're in. This is a big deal, this bucket idea. And secondly, build the firm right. Like don't try to cut corners, like build a real solid firm, checking all the boxes.
So on the worst piece of advice, anyone discourage you saying, now's not the time to launch, why do you want to go out today?
All the time.
All the time?
All the time. The first 5, I think the biggest annoying part was I wanted to start a public fund, and because, my view was, I was a banker, I saw the diligence, the investment in Silicon Valley, and this is controversial, I think the diligence process had significantly deteriorated over the last 15 years, right? The strong diligence process that we had in late 2000, late 2010s significantly deteriorated because people are chasing exciting technology things. And so, and I've seen how people gave me money when I was on the other side with very little diligence because they wanted the Snap logo. And so I didn't want to compete on that business, and I said, we're not going to do private. I have not done a single private out of the fund, and people will just keep pushing me to do private in early days. And, I think, and I just,
stick to your knitting.
Focus on what you like. I like public market.
I got a few really good questions, but we only have a couple of minutes left. Can we address the elephant in the room? Fundraising is extremely tight in general, given competition from private markets and limited DPI. What do the panelists think their edge is in this critical area for a startup? First, do you find fundraising tight? And second, what's your edge? Matt?
That was this, Matt. I think fundraising is challenging, especially for a startup. I think our edge, though, the way to answer that is a deep team with tons of experience, 30 years of experience for each one of them. So you said earlier that it's like trust. They have to trust you. They have to trust that you know what you're doing and that you have experience in these markets. And I think our other edge is a really quantitative, data-driven approach that we can replicate. And I think that's another part of the edge. But at the end of the day, having relationships and having the business development effort there is also critical to be able to have those conversations. So it's a combination of things.
Imran, how about you?
So my first philosophy in life is focus on things that you really, really like. And I love stocks. I always liked stocks. I like investing in tech. So I started with a very low expectations of raising capital. So to me is like, listen, we have a strong domain expertise. We've seen cycles, last 3 cycles in tech, that when stock went down 2001, 2008, and 2022. And I think we have a process that I enjoy. And so if people find it right, they will give money. If they don't, no hard feelings.
And
Build it
finally,
for long
we'll
term.
wrap up with you, Matt. No pressure. What
I think there are complicated things in the world, and I think there are simple things in the world. I think if you're transparent with your risk and you deliver returns and you do that again, people will want you to do it again, and they'll give you more to do it with. So, people like to think JP Morgan's this gigantic place, and it is. They like to think all these businesses are huge, and it is, but it wasn't always like that. And so, kind of Saturday morning at 1 a.m. in mid-March of 2008, I had 30 people hand-marking bonds. They wanted to shut down certain businesses. We were absorbing Bear Stearns. You build things over time through trust. It's a long-term game. And, I think you stick to what you know and what you're good at, and the things fall into place. My partner likes to say, my business partner likes to say, it's always a hard environment to raise capital. It's always a good environment. It's always a hard environment, is what it is.
perfect spot to wrap up. We're out of time. Let's say thank you to Matt, and Imran. Really appreciate their time.